Hello, and welcome to Mastering Finance with Dean Tellone. I'm your host, Dean Tellone, and this is episode 9. Today we're diving into how real estate prices will evolve, market trends, and predictions. In this episode, we'll explore the key factors that influence real estate prices, from supply and demand to interest rates, inflation, economic growth, and government policies, and discuss how these forces shape market trends. We'll take a look at historical real estate cycles, booms, and busts, and see what past trends can teach us about the future. You'll also hear real-world examples of housing market booms and corrections, including some recent developments in both residential and commercial real estate. Whether you're a first-time home buyer, a seasoned real estate investor, a commercial property owner, or a high net worth individual with a stake in property, we've got insights tailored for you. By the end of this episode, you'll not only have predictions from experts on where the market might be headed, but also some practical, actionable advice to help you make informed real estate decisions. So get comfortable and let's start mastering finance in the world of real estate. Key factors influencing real estate prices. Aerial view of suburban housing development illustrating the residential real estate market. Real estate values don't move randomly. They are driven by fundamental economic forces. Understanding these factors can help explain why home prices rise or fall. Let's break down 5 of the most important drivers: supply and demand, interest rates, inflation, economic growth, and government policies in a straightforward way. Supply and demand. Just like any market, housing prices are largely determined by supply and demand. If there are more buyers looking for homes than there are houses available, high demand and low supply, prices tend to climb. We've seen this in recent years when housing inventory was historically low in many areas, leading to bidding wars and rapid price increases. On the flip side, if there's a plentiful supply of homes, but fewer interested buyers, say due to economic downturns or overbuilding, prices can stagnate or even fall. A simple example: imagine a small town where 100 buyers are trying to find a home, but only 50 houses are on the market. Those houses will likely sell for a premium. Conversely, if 100 houses are for sale but only 50 buyers are looking, sellers might have to cut prices. Key takeaway: tight supply pushes prices up, excess supply pulls prices down. This dynamic is why analysts watch metrics like housing inventory, the number of homes for sale, and new construction rates so closely. Interest rates. Interest rates, especially mortgage rates, have a huge influence on real estate prices. Most home buyers rely on mortgages, and the interest rate determines how expensive that loan will be. When interest rates are low, borrowing is cheaper, which means buyers can afford larger loans and thus pay more for houses. Lower rates therefore tend to boost housing demand and prices. We saw this in 2020 to 2021 when mortgage rates hit record lows. Buyers flooded the market and home prices surged. Conversely, when interest rates rise, mortgages become more expensive. Higher monthly payments price some buyers out, so demand falls and price growth slows, or prices even drop. A dramatic historical example: in the early 1980s, U.S. mortgage interest rates soared to around 18%, making home loans incredibly costly. This killed the housing market at the time because so few people could afford to buy. While today's rates aren't that extreme, the increases we've seen recently, from about 3% to 6 to 7% for a 30-year mortgage, have significantly cooled the frenzy of buyers. In short, low interest rates fuel real estate booms, and high rates can pump the brakes on prices. Inflation. Inflation is the general rise in prices of goods and services, and it plays an interesting dual role in real estate. On one hand, inflation can push real estate prices up. Why? As the costs of land, building materials, and labor increase, it becomes more expensive to build new houses or commercial projects. If people still want homes and buildings, but building new ones costs more, the existing properties in the market become more valuable. Limited supply of housing meets sustained demand. Also, many investors view real estate as a hedge against inflation, an asset that will hold value or appreciate when currency value is falling. So during inflationary times, demand for property can increase. On the other hand, high inflation usually prompts central banks, like the U.S. Federal Reserve, to raise interest rates to cool down the economy, which, as we just discussed, can put downward pressure on real estate demand. Think of the 1970s. Inflation was very high, and home prices did rise in part because building costs went up. But then the Fed jacked up interest rates to nearly 20% by 1981, which sent the housing market into a slump. So, inflation's impact on real estate is a bit of a balancing act between rising replacement costs, pushing prices up, and the effect of higher interest rates, pulling demand down. Moderate inflation often coincides with rising home values, whereas runaway inflation can lead to the kind of interest rate shock that cools the market. Economic growth and jobs. The broader economy has a straightforward effect. When the economy is strong, real estate tends to do well. When the economy is weak, real estate often struggles. In a growing economy, people have jobs, incomes are rising, and consumer confidence is high. More folks can afford to buy homes or upgrade to bigger ones, and businesses might expand into new offices or stores. For example, if a big company opens a new headquarters in a city and hires lots of employees, you'll likely see housing demand and prices in that area shoot up as those workers search for homes. A strong economy with low unemployment generally boosts housing demand and home prices. Conversely, during a recession or economic downturn, people may lose jobs or worry about their finances. Fewer people feel confident enough to buy a house, and some who are struggling might even be forced to sell or foreclose. The Great Recession of 2008 is a prime example. As the economy crashed and millions lost jobs, demand for homes plummeted and a flood of distressed sales hit the market, causing home prices to collapse in many regions. We'll talk more about that in a moment. In commercial real estate, a weak economy means businesses may downsize or close, reducing demand for office space, retail space, etc. The lesson here is that real estate doesn't exist in a vacuum. It's closely tied to the health of the overall economy. Watching indicators like employment rates, income growth, and GDP can give clues about housing demand in the near future. Government policies. Government actions and policies can significantly influence real estate markets, sometimes in subtle ways. Monetary policy, like the Federal Reserve's decisions on interest rates, directly impacts mortgage rates and thus buyer affordability. But beyond that, there are tax laws, subsidies, and regulations that can boost or hinder real estate. For instance, governments often offer tax incentives or credits for home buyers or real estate investors. A real-world example. In 2009, amid a slow economy, the U.S. government introduced a first-time homebuyer tax credit to spur home sales, and 2.3 million people took advantage of it. That kind of policy temporarily increased housing demand by nudging renters into buying their first home. Government can also influence the supply side. Zoning laws, building codes, and development regulations determine how easily new housing can be built. In places where it's hard to get permits or where there are strict limits on development, housing supply grows slowly, which can drive prices up if demand is strong. Rent control policies, limiting rent increases, might keep rents affordable for some, but they can also discourage new housing construction. Additionally, fiscal policy, and broader legislation matter. For example, property tax rates affect the cost of owning, and infrastructure spending can open up new areas for development. In short, government policy can act as either a tailwind or headwind for real estate. Being aware of current incentives or regulations is important. They might create short-term bumps or slumps in demand that don't necessarily last once policies change. These key factors, supply and demand, interest rates, inflation, economic growth, and government policy, often interact with each other. Real estate is complex because sometimes these influences push in different directions. But keeping an eye on these fundamentals provides a solid grounding for understanding market trends. Now that we've covered the ingredients that move prices, let's look at how the real estate market has actually behaved over time and what history can tell us about the future. Historical real estate cycles, lessons from the past. Multiple house for sale signs clustered together, a scene that can occur during a housing downturn when supply far exceeds demand. Real estate markets are cyclical. Over the decades, we've seen periods of booming prices followed by corrections or busts, and then recovery phases. Understanding these cycles can help us recognize patterns and avoid repeating past mistakes. Let's explore a few notable episodes in real estate history and see what lessons they offer for today. Late 1980s, boom, and early 1990s. Slump. In the 1980s, many housing markets were hot. Economies were growing, and inflation made hard assets like houses attractive. However, by the end of the decade and into the early 1990s, things changed. A combination of high interest rates, partly due to the Federal Reserve's efforts to combat late 80s inflation, and an economic recession led to a real estate slowdown. In the U.S., there was also the savings and loan crisis, a banking debacle, around 1989 to 1991, which tightened credit for home buyers and builders. The result? Home prices stagnated or fell in many regions in the early 90s, and new home construction dropped sharply. In some areas, homeowners who had seen values shoot up in the 80s suddenly found their homes sitting on the market with for sale signs without many takers. The lesson from this cycle is that even after a strong boom, a market can cool off for years if economic conditions turn or if there was overexuberance. It's a reminder not to assume prices only go up. What goes up can flatten or come down, at least temporarily when the cycle turns. The 2000s housing bubble and the 2008 crash. This is one of the most famous real estate cycles, and for good reason. In the early to mid-2000s, U.S. housing and several other countries' markets went into overdrive. Easy credit and loose lending standards meant many people could get mortgages with little proof of income or with tiny down payments. Banks were handing out subprime loans, and Wall Street was eagerly buying those mortgages and turning them into investments. Demand for homes exploded. Everyone from first-time buyers to speculators buying multiple houses, and home prices shot up year after year, roughly doubling in some American cities between the late 90s and 2006. It felt like a never-ending boom until it wasn't. The cracks started to show around 2007 when interest rates had risen from earlier lows, and many borrowers with adjustable rate mortgages saw their payments jump. Suddenly, a lot of people couldn't afford their mortgages, and with lending standards tightening, new buyers couldn't step in to prop up the market. The bubble burst. Home prices crashed by 30%, 40%, or more in some areas, from 2006 to 2009, wiping out trillions of dollars in homeowner equity. Foreclosure signs popped up everywhere as hundreds of thousands of people defaulted on loans. Banks and financial institutions took huge losses, and the housing crash spiraled into a global financial crisis. It was the worst housing bust since the Great Depression. The big takeaway? Don't assume that housing prices can't fall dramatically. They can if prices detach from fundamentals, like people's incomes, and if speculative fever takes hold. However, the aftermath also taught us that markets do eventually heal. Thanks to a combination of government intervention, rock-bottom interest rates, and time, the housing market found a floor around 2011 to 2012 and began a steady recovery. Those who bought at the peak in 2006 and held on eventually saw values come back in many cases, but it took years. For investors and home buyers, the 2008 crash reinforced the importance of buying within your means and not banking on endless price gains. The 2020 pandemic boom and recent cooldown. The COVID-19 pandemic brought an unexpected twist to the real estate cycle. In early 2020, when the pandemic first hit, there was a brief freeze in the housing market. People were locked down and activity stalled, but very soon, a combination of factors launched an extraordinary housing boom. The Federal Reserve slashed interest rates to near zero to support the economy, which drove mortgage rates to record lows. Suddenly, buying a home became cheaper on a monthly payment basis than it had been in years. At the same time, many people, forced to stay at home, realized they wanted more space or a different location, especially if they could work remotely. Urban apartment dwellers started looking for suburban or rural homes with home offices and yards. This surge in demand, coupled with the fact that home construction had been lagging and many sellers held off listing during the pandemic, led to a severe supply shortage. The result? Home prices skyrocketed in 2020 to 2021. It wasn't uncommon to see double-digit percentage price increases in a single year, something virtually unheard of in normal times. Houses were selling within days, often above the asking price, as buyers competed fiercely. By mid-2021, people were routinely bidding over list price and waiving inspections just to secure a home. It was a true housing boom. Now, fast forward to 2022 to 2023, the boom began to temper. Why? Inflation jumped in the economy, partly a side effect of pandemic stimulus and supply chain issues, and central banks responded by raising interest rates quickly. In the U.S., the Fed's rate hikes pushed the average 30-year mortgage rate from around 3% to over 6 to 7%, the highest in about 20 years. That sharply reduced affordability. Many buyers found that the same house now cost hundreds of dollars more per month in mortgage payments compared to a year prior. By 2023, the housing market cooled in many regions. Sales volumes dropped as buyers and sellers hit a standoff. Buyers didn't want to pay peak prices at high rates, and many homeowners didn't want to sell and give up their own low-interest mortgages, a phenomenon known as the mortgage lock-in effect, where people stay put because they don't want to refinance into a higher rate. Prices, however, did not crash like in 2008. In fact, nationally, home prices merely leveled off or dipped slightly in some areas and continued rising modestly in others. One major reason is that supply was still very tight. Home builders couldn't ramp up enough, and many existing homeowners chose not to sell, so inventory stayed low. By late 2024 and into 2025, we saw a very mixed picture. Some overheated markets, like certain pandemic boomtowns, saw prices correct downward 5 to 10%, while many others saw flat or slowly rising prices again as the economy remained fairly strong. The pandemic boom and its aftermath underline a key lesson. Shocks can create unusual housing cycles. Who would have predicted a pandemic would ignite a housing frenzy? And the fundamentals of supply and demand still rule. Because supply was so constrained, the correction that followed the boom was relatively mild instead of a bust. In summary, history shows that real estate markets can heat up and cool down in cycles influenced by the factors we discussed earlier. Booms can last years, but none last forever, and downturns, while painful, also eventually give way to recovery. By studying past cycles, whether it's the overexuberance and crash of 2008 or the recent pandemic roller coaster, investors and home buyers can learn to approach the market with a bit more caution and realism. Past trends remind us to expect the unexpected and to always consider what-if scenarios. Next, let's look at how different segments of real estate, residential versus commercial, are performing, and then we'll jump into some predictions for the future. Residential versus commercial real estate trends. Not all real estate is the same. Broadly, we can divide the market into residential, homes, apartments, condos, properties where people live, and commercial, office buildings, retail stores, warehouses, industrial properties, and large apartment complexes, properties used for business or investment purposes. These segments can follow different trajectories, especially in recent times. Let's unpack their trends. Residential real estate, residential properties, particularly single-family homes, have been the star of the real estate show in recent years. As we discussed, the housing market saw a major boom in 2020 to 2021, with home prices reaching all-time highs in many countries and cities. Even in 2022 to 2024, with higher interest rates, home prices didn't drop dramatically overall because of the persistent shortage of houses for sale. In the United States, for example, the inventory of homes on the market has remained well below normal levels. Many analysts say the U.S. is millions of homes short of what's needed. This lack of supply put a floor under prices. Instead of a buyer's market crash, we mostly got a stalemate, fewer sales happening, but prices staying relatively stable or growing slowly. Another trend in residential real estate is location shifts. The pandemic accelerated moves from high-cost, dense urban areas to more affordable suburbs or smaller cities. For instance, some people left San Francisco or New York City to buy larger homes in places like Austin, Phoenix, or Nashville. This caused regional booms. Many Sunbelt cities saw huge price jumps, while some expensive city centers saw rents and prices dip in 2020 before recovering later. Now that workplaces are reopening, there's a bit of a balancing act. Cities are coming back, but many workers have more flexibility, so suburban and rural housing demand remains strong. Going forward, residential real estate's outlook will depend on those key factors we discussed. Interest rates. Will mortgages get cheaper? Economic conditions. Will incomes grow to support current prices? And supply. Will builders construct enough new homes to meet demand? As it stands, the residential market appears to be transitioning to a more normal pace. Homes aren't selling overnight as often. Buyers have a bit more negotiation power than during the peak frenzy, and year-over-year price gains have cooled to single-digit percentages or flat in many areas, which is a healthier, more sustainable trend. Commercial real estate. The commercial side of real estate is a mixed bag and has faced some unique challenges recently. The big headline here is office space. The rise of remote work, hugely accelerated by the pandemic, has fundamentally changed the office market. Many companies discovered that employees could work from home effectively, and even as COVID subsided, a significant number of workers did not return to the office full-time. As a result, demand for office space has dropped in many cities. Office vacancy rates hit record highs. In the U.S., the office vacancy rate was around 19 to 20% in 2024, the highest on record. Think about that. Nearly 1 in 5 office spaces empty on average, and in some downtowns, it's even more. This oversupply of office space has pushed office property values down and created serious concerns for owners and investors in that sector. Some older office buildings in big cities may even be converted to apartments or other uses because there's just not enough office tenant demand. On the other hand, not all commercial real estate has fared poorly. Industrial real estate, like warehouses and distribution centers, has been booming thanks to the rise of e-commerce and the need for logistics space. All those online orders need big warehouses. Rents and prices for industrial properties have been strong. Retail real estate, stores, shopping centers, went through a tough period. Even before the pandemic, the retail apocalypse was a term as online shopping grew. COVID lockdowns dealt another blow, with some brick-and-mortar stores closing for good. However, well-located retail centers and those that offer experiences, think restaurants, entertainment, not just goods, have been recovering. Multifamily residential, apartment buildings, is technically commercial too, since they are often owned by investors, and that segment has been relatively resilient. In fact, high home purchase prices and higher mortgage rates have kept more people renting, which has upheld strong demand and rising rents for apartments in many cities. So within commercial real estate, it's a story of divergence. Some sectors like office are in a downturn, while others like industrial are thriving. For commercial property owners, factors like the state of the economy, are businesses expanding or contracting, technological shifts, e.g., rise of remote work or online shopping, and financing conditions, commercial loans have also become costlier with interest rate hikes, all play a role in property values. As we look ahead, a key question is, will offices rebound or will companies continue to reduce their footprint? That could shape the skylines of cities and the investment performance of commercial real estate in the coming years. In essence, residential real estate has been robust, sometimes too robust, recently, while commercial real estate's fate varies by the type of property. For our listeners, the important thing is to recognize which submarket you're interested in. The strategy for buying a family home is different from investing in an office building. Next up, let's talk about predictions. What do experts think will happen to real estate prices in the near future? And later, we'll give some actionable tips for different types of real estate participants. Market trends and predictions for the future. Now, the big question, where are real estate prices headed from here? While no one has a crystal ball, economists and industry experts do analyze data and make forecasts. The consensus view at the moment is that we shouldn't expect either a massive boom or a dramatic crash in the near future. Instead, a more gradual, modest evolution of prices is likely, barring any major economic shocks. Let's break down the predictions for residential and commercial markets and the indicators to watch. Housing market predictions. After the frenzied run-up of home prices in the early 2020s, most analysts predict growth will be much slower in the next few years. In fact, a lot of forecasts for U.S. home prices in 2025 and beyond hover in the low single-digit percentage increases per year. For example, Fannie Mae, the large government-sponsored mortgage company, expects home prices to rise only around 3.5% in 2025. The Mortgage Bankers Association forecasts about 1 to 2% growth in home prices that year, and the National Association of Realtors is along similar lines, with a few percent increase each year in their outlook. What's behind these tepid growth predictions? High mortgage rates are a big factor. Even though rates might ease a bit from recent peaks, they're not expected to return to the rock bottom levels of 2020. We might see mortgage rates drift down gradually if inflation continues to cool, perhaps into the 5 to 6% range over the next year or two, according to some forecasts, which could give a little boost to buyer demand. But as long as rates remain significantly above the 3 to 4% of the past, there's a natural cap on how much buyers can pay. Another factor is affordability. Home prices grew so much faster than incomes in the past few years that many first-time buyers are simply priced out. It will take time, through either incomes rising, prices stalling, or some combination, for affordability to improve. The good news is, experts overwhelmingly do not anticipate a 2008-style crash ahead. Why not? Mainly because the credit quality of homeowners is much higher now, stricter lending standards, so fewer risky loans out there. And because that supply shortage is real, we haven't overbuilt. In fact, we've underbuilt. As one economist put it, a housing crash would likely require a wave of forced selling, like foreclosures, which would likely only happen if unemployment spiked and people couldn't pay mortgages. Right now, the job market has been pretty solid, and most owners who bought in recent years have fixed low interest rates and some equity cushion. So, absent a severe recession, a gradual moderation is the base case. Think continued small price gains or flat prices in many areas, with perhaps some local ups and downs. Some previously overheated markets might see minor price declines, while affordable markets with strong population growth could still see decent gains. Essentially, a more balanced market may emerge, one that neither heavily favors sellers, as it did in 2021, nor buyers, like it did after the 2008 crash, but something in between. Commercial market outlook. For commercial real estate, predictions vary by sector. Office real estate is widely expected to remain soft. Many companies are still reevaluating their space needs, and with higher interest rates, refinancing office building mortgages has become more expensive. That financial pressure could lead to some distress sales of office towers, especially older ones. Some analysts predict office property values in big cities could fall further before finding a bottom, potentially rebounding only if buildings are repurposed or if demand somehow returns. Retail real estate has a cautious outlook. Neighborhood shopping centers focused on essential goods and services are doing okay, but big malls continue to face challenges unless they reinvent themselves as entertainment or mixed-use destinations. Industrial and logistics properties are a bright spot. As long as e-commerce keeps growing, companies will pay premiums for well-located warehouses, so rents and values in that segment are expected to stay strong. Multifamily, apartments, is also generally positive in outlook. While rent growth slowed after a big post-pandemic burst, there's still robust demand for rentals, and many investors like apartments as an asset class. One thing weighing on all commercial sectors is the higher interest rate environment, which makes financing deals pricier and can lower the values investors are willing to pay. When interest rates rise, investors often demand higher yields from properties, which translates to lower property prices unless rents rise enough to compensate. We're already seeing fewer big commercial property transactions as buyers and sellers try to reconcile price expectations. Expert predictions in commercial real estate suggest that well-leased properties in strong locations will hold value, whereas properties with shaky income, like half-empty office buildings, could see further price declines. Some even warn of a potential commercial real estate crunch in certain cities, but it's likely to be contained to specific segments rather than an across-the-board crash. Key indicators to watch. For where prices will go, keep an eye on a few things. Interest rates are number one. If inflation continues to come down and central banks stop raising rates or start cutting rates, that will gradually make mortgages and loans cheaper, potentially boosting real estate demand. In fact, any hint of significant rate drops could spur a mini surge of buyers who were on the fence. Conversely, if inflation flares up again and rates rise further, that would put more downward pressure on prices. Economic health is another. Watch unemployment rates and consumer confidence. A recession with job losses could soften housing demand and increase forced sales, which would be a downside risk to prices, whereas a soft landing, where inflation is tamed without a big unemployment jump, would be more benign for real estate. Also, housing supply metrics. If home builders significantly ramp up construction, which they are trying, but are constrained by labor and materials costs, increased new home supply could slow price growth. Right now, though, builders are cautious. They're building, but not at a pace that would glut the market. On the commercial side, watch return to office trends. Any shift in company policies could affect office demand and retail spending habits. Consumer behavior affects store viability. In summary, the road ahead for real estate prices will likely be one of steady, modest changes rather than extreme swings, assuming the broader economy remains relatively stable. Most experts anticipate that in 2 to 3 years, home prices will be a bit higher than today, but growing at a much slower rate than the craziness of 2020 to 2021. And importantly, they say a dramatic nationwide crash is unlikely without a major economic downturn fueling it. Of course, real estate is local. Some markets will outperform others. So do pay attention to your local conditions. Now, given these trends and predictions, what should you do? In our final segment, let's translate this knowledge into actionable insights for different kinds of real estate participants. Actionable insights for buyers, investors, and property owners. Understanding market trends is valuable, but knowing how to act on that knowledge is even better. In this section, we'll share practical advice tailored to various members of our audience. First-time home buyers, real estate investors, commercial property owners, and high net worth individuals involved in real estate. No matter which category you fall into, the goal is to help you make informed, savvy decisions rather than reacting emotionally to headlines. Let's dive into specific tips. For first-time home buyers, if you're looking to buy your first home, the market can feel intimidating, especially after the price run-ups we've seen. The key advice is focus on what you can afford and think long-term. Don't try to precisely time the market or wait for a mythical crash that experts say likely won't happen soon. Instead, evaluate your own finances. Get pre-approved for a mortgage so you know your budget, and aim for a home that you can comfortably afford the payments on, even if rates tick up. In the current environment, you might face less competition than buyers did a year or two ago, which is good news. You can take a bit more time to shop around, and you might even be able to negotiate on price or ask for repairs, concessions, which was tough to do during the red-hot market. Be aware of interest rate trends. If rates are high now and you can't wait to buy, you can plan to refinance later if rates drop. So marrying the house, dating the rate, as the saying goes. Also, look into first-time buyer programs or government incentives. There are often special loans or grants that can help with down payments or closing costs. One more tip. Consider buying for the life you have now, not an imagined perfect scenario. It's easy to get caught up wanting your forever home with every feature, but maybe your starter home can be more modest. As you build equity, you can always trade up in the future. Remember, over the long term, real estate tends to appreciate, and owning can be a path to building wealth. But only if you buy something that remains affordable for you. So make a solid budget, stick to it, and don't get discouraged by a challenging market. Opportunities are still out there. For real estate investors, whether you're investing in single-family rental properties, duplexes, or larger multifamily buildings, the name of the game is due diligence and a focus on fundamentals. In a market that's not skyrocketing, you can't count on quick price appreciation to bail out a mediocre investment. So, buy for cash flow. if it's a rental, and quality. Look at areas with strong employment growth and population growth. Those tend to support high occupancy and rent increases. Run the numbers conservatively, account for higher interest rates in your financing costs, factor in maintenance, vacancies, and property management fees. If the deal only makes sense with optimistic assumptions, be cautious. Given the uncertainty in interest rates, some investors are adopting a strategy of stress testing their deals. For example, asking, would this property still be profitable if my mortgage rate were 1% higher than today? If yes, that's a buffer of safety. Diversification is also wise. Instead of putting everything into one property or one market, consider spreading investments across different regions or property types to mitigate risk. Keep an eye on local regulations. For instance, some cities are introducing strict rules on short-term rentals, like Airbnb, which could affect your plans if you were counting on that strategy. In the current cycle, you might find opportunities in places where others are fearful, e.g., perhaps a slight downturn in a particular city lets you buy a good property at a relative discount. Just ensure it's something you'd be comfortable holding if the market stays flat for a while. As always, have a reserve fund for your investments. Unexpected costs happen, and in a slower market, you want the staying power to hold an asset through any dips. Finally, consider the financing. You may opt for fixed-rate loans to lock in your costs. Since rates are elevated, avoid the risk of a variable rate spiking on you. And if rates fall later, you can refinance to improve cash flow. In short, investors should be prepared for more normal returns, do their homework, and think about income generation and resilience more than quick flips. For commercial property owners, if you own or are looking to own commercial properties, be it office, retail, or industrial, the strategy should adapt to the specific sector. Office owners, this is a challenging time, no doubt. Focus on attracting and retaining tenants. That might mean investing in renovations to modernize spaces. Companies now want very attractive offices if they're going to ask employees to commute in, or offering flexible lease terms to credible tenants. Get creative. Could that empty floor be converted to a different use, like a small co-working space or even residential units if zoning allows? Stay on top of your debt obligations. If you have loans maturing soon, talk early with lenders about refinancing options. You don't want to be forced to sell at a bad time. Retail owners, pay attention to the tenant mix. Properties that incorporate service-oriented businesses, like healthcare clinics, gyms, restaurants, tend to be more internet resistant. Community-focused retail can still thrive. It might also be worth engaging with local business groups or economic development offices to fill vacancies. Sometimes they have programs to help activate empty storefronts. Industrial owners, you're in a good spot, but don't rest easy. Make sure you have solid long-term leases and consider locking in tenants now while demand is high. Across all commercial types, keep an eye on expenses. Insurance, property taxes, and maintenance costs have been rising. Anything you can do to improve efficiency, like energy-saving upgrades, can help the bottom line. Networking with other commercial owners can provide insight. For instance, local real estate meetups or industry groups can share who's moving into town or which companies are expanding, contracting. Lastly, consider getting professional property management help if you haven't already, especially for larger properties. Good management can make a big difference in keeping tenants happy and properties profitable during tougher times. The commercial landscape is evolving, so successful owners will evolve with it, finding ways to repurpose or upgrade their properties to meet today's market demands. For high net worth individuals and luxury property owners, high net worth individuals often have a slightly different angle on real estate. You might be buying luxury residences, vacation homes, or investing in commercial projects or real estate funds. One piece of advice is diversification. If a lot of your wealth is tied up in real estate already, be mindful of concentration risk. Luxury real estate in particular can have its own cycle. Ultra-high-end properties saw big gains in recent years as wealthy buyers snapped up estates, but this segment can be more illiquid in downturns. So, if you're buying a luxury home, buy it because you truly want to use and enjoy it, and consider the resale icing on the cake. It might take longer to sell a $10 million home than a $300,000 home if the market slows. For investment, high net worth individuals might look into commercial real estate syndications or REITs, real estate investment trusts, to get exposure without having to manage properties directly. This is a way to benefit from real estate trends, like the growth in data centers or cell tower real estate, for example, by investing in specialized funds. Tax strategy is another area. Work with financial advisors to take advantage of things like 1031 exchanges to defer taxes when selling one investment property and buying another, or opportunity zone investments, if appropriate. If you own multiple properties, estate planning and how to structure ownership, trusts, LLCs, etc., becomes important too. Given the current predictions of modest growth, high net worth investors might focus on value-add opportunities, using their capital to improve a property, renovate an older apartment building, for instance, to increase its value, rather than counting on market appreciation alone. Also, keep an eye on global markets. Sometimes international real estate can be attractive, either for diversification or personal use. For example, some investors look to cities in Europe or Asia for bargains or growth potential when their home markets got too hot. Just be cautious and research those markets thoroughly. In some, for wealthy individuals, real estate strategy in this environment is about prudent allocation of capital, leveraging expert advice for tax and legal structuring, and ensuring your real estate holdings align with your overall financial goals, be it income, long-term growth, or personal enjoyment. No matter who you are, a universal piece of advice is stay informed, but also stay level-headed. It's easy to get caught up in doom and gloom media narratives or, conversely, hype about the next big boom. As we've discussed, the reality is usually somewhere in between. Use data and expert insight like you're getting from this podcast to guide your decisions. And always remember the real estate mantra: location, location, location. A great property in a strong location will tend to hold value and perform well over the long run, whereas a speculative bet on a fringe area at the peak of a frenzy can be risky. Conclusion. As we wrap up episode 9 of Mastering Finance with Dean Tellone, let's quickly recap what we've covered. We explored how fundamental factors, supply and demand, interest rates, inflation, economic growth, and government policies all intertwine to influence real estate prices. We looked back at history, from the housing booms and busts of past decades to the unprecedented pandemic surge, to understand that while the market moves in cycles, those cycles have discernible causes and eventually recover. We distinguished between residential and commercial real estate trends, noting that each segment has its own story in today's market. And we discussed future predictions, which suggest a period of moderation. No runaway boom on the horizon, but thankfully, no expected crash either, according to expert analysis. Finally, we translated these insights into actionable advice for a range of audiences. Whether you're buying your first home, investing in properties, managing commercial real estate, or handling a luxury portfolio. The overarching theme is informed decision-making. Real estate is often the biggest investment people make, and it can be a significant part of one's financial portfolio. By understanding the factors at play, and learning from both past trends and current data, you put yourself in a position of strength. Remember that knowledge is power. The more you know about how the market works, the better you can navigate it. Markets will always have some uncertainty. Unexpected things can happen, as 2020 taught us. But having a solid foundation in the fundamentals and a clear head will help you adapt if and when conditions change. As a call to action, I encourage all of you listening. Apply these insights to your own situation. If you're a prospective home buyer, maybe start that budget or talk to a mortgage advisor to see what's realistic. If you're an investor, perhaps take a fresh look at your portfolio and see if it's aligned with the trends we discussed. If you're a property owner, think about the tips on adding value and staying ahead of market shifts. And no matter what, don't hesitate to consult professionals. A trusted real estate agent, financial planner, or mortgage broker can provide personalized guidance and help you interpret market conditions in real time. Thank you for joining me today on Mastering Finance. I hope this episode has demystified some of the complexities of the real estate market and given you confidence to make well-informed decisions. Real estate will continue to evolve, and as it does, we'll be here to break it down for you. If you found value in this podcast, please subscribe and share it with others who might benefit. Until next time, this is Dean Tellone reminding you to stay informed, stay proactive, and as always, keep mastering your finances. Here's to making smart real estate moves in the days ahead. Global real estate decisions are significant. Make them wisely, and you'll thank yourself in the years to come. And thanks for listening, and see you on the next episode.